fair value gaps form on every single time frame, every single pair all day long. But the truth is, most traders don't understand how to actually trade them. They see a fair value gap form and they jump into a trade. But what's the higher time frame context? What's the actual target for price? And does this fair value gap make sense to enter? That's what we're going to explore in this video. And I'm going to show you exactly how to use fair value gaps to get into high probability trades like this 2.5R that played out perfectly on CADCHF. So let's get into it. So I'm just going to take that away for a second and show you what I'm looking at. So this is the 12-hour time frame. We're swing trading, so we want to use this as our execution time frame. And we want to trade weekly, 2-weekly, and monthly higher time frame ideas. And we're going to use how candles close and the interaction between candles to get into high probability trades. So let's start by just overlaying on this time frame the weekly time frame. So here what we see is that price moves aggressively upwards. But importantly, what you see is that the weekly candle, this entire area here, forms a bullish range. It's a bullish candle. In the next candle, price sweeps above this candle's range. So it breaks out from the high. What it then does is it closes at this point here inside this candle's range. This exposes the low of this candle as a higher time frame target in the market. Why? Because price does this all day long. Accumulation, manipulation, and then distribution aggressively to the lows. It's called candle range theory. So how do we then use fair value gaps? Well, these are our points of internal range liquidity to take high probability trades. So as soon as this candle prints, we have manipulation. Now we know where price wants to go. We can then see price sells off and we get the formation of our first fair value gap. And it sits right here between the order block, which is the last buy to sell, and this candle here. So candle 1, price drops, candle 2 creates an inefficiency in price. So price will want to fill the fair value gap before it then continues lower. What it does is it comes through and it fakes to go higher, tagging the order block. It then starts to drop away, creating a new price leg. What happens in the creation of that price leg? Well, you see there's a new fair value gap between candle 1 and candle 3. So we can then mark that. Here it is. It's very subtle, but you see this is a fair value gap, an inefficiency in price. What happens next is as soon as this fair value gap confirms, the inefficiency is filled. So we can enter our position from the fair value gap, covering the newly formed swing point. Where's our target? Well, the technical target in the market is here, and that actually plays out. That's a 7.6R trade. Now, you might just want to hold this for a fixed 2.5R or maybe a 3R, or if you want to hold this to the technical target, it makes perfect sense. What makes this an even better trade is that you have the monthly on side. If we take away the weekly and look at the monthly candle, here is the previous monthly candle's range. Price breaks to the upside and it is reacting from the previous month's high. So it actually does make sense that this candle may want to continue lower, which means this is a perfectly feasible trade. 7.64R by understanding when to enter a fair value gap in context. Let's look at another example. So on EURGBP, we get the exact same thing. I'm just going to overlay the weekly candle. So right here we see this accumulation candle. It's manipulating its previous candle's range. So we're expecting price to distribute to this high. But what happens is that price breaks above the previous range high and then drops. It then creates a fair value gap, a bearish fair value gap. And we can just mark that on our chart. So it sits again in between the order block, the last buy to sell, candle 1, candle 2, candle 3. There's the inefficiency. So again, we can enter a short from the inefficiency. Where do we cover? Probably the swing point, the order block high. And the actual technical target for price is the exact same place. It's the low of the accumulation candle. Accumulation, manipulation, distribution. Now let's look at the monthly candle. We take that away and look at the monthly candle. We can see price is doing the exact same thing on the higher time frame. Accumulation, we manipulate higher right here, then the monthly candle closes. So where's the actual technical target for price? It's the low of the manipulation candle. And that's exactly where price goes. So we can actually hold this for a much bigger swing trade, 4.34R. So the beauty of fair value gaps is trading them in context with higher time frame candle behavior. We're always trading higher time frame, accumulation, manipulation, distribution. I trade this every single day in less than 15 minutes, swing trading over 30 Forex pairs. I have a 3-part series that is live on my YouTube channel, which you can check out for free. See you on the next video.